Hi, I am Anna. I come from www.ntvforex.com. Global stock markets are still in the vortex of the COVID-19 crisis. http ntvforex.com News ID 26B515. 7/17/2024 56 p.m. After last week's Black Thursday, global markets fell again on June 15, with the MSCI Asia ex-Japan Index down 2.34% and Nikkei 225 down 3.47%. South Korean stock market fell even more, with the Kospi plunged 4.76%. Hong Kong's Hang Seng Index fell 2.17% and China's A share market also falling somewhat. Europe's main stock indices fell sharply across the board in early trading. According to data, as of 15:16 Beijing time, the UK FTSE 100 index, the French CAC 40 index, and the German DAX index fell 2.15%, 2.87%, and 2.80%, respectively. Meanwhile, US stock index futures fell sharply, with the Dow Jones 30 down 3.49%, the S&P 500 down more than 3%, and the Nasdaq 100 down 2.45% by the same time. Risk aversion surged, with the S&P 500 VIX index futures, a fear gauge, rising 13.57%. What is happening in financial markets is characterizing a second correction. International crude oil futures also fell under the influence of risk aversion, with WTI crude futures fell 4.91% and Brent fell 3.59%. The decline in global stock markets could be deemed as a continuation of last week's sharp pullback in the U.S. stock market. The correction came amid heightened fears of a resurgence of the coronavirus and investors' profit-taking after a sharp rebound in the stock market. As Onbound once pointed out, the change in the pandemic is still the main factor affecting the stock market. A rebound in the current outbreak will weigh on global markets. Statistics show that on June 14, the number of cases in 8 U.S. states over the past 3 days was the highest ever recorded, suggesting a second wave is fast approaching. According to real-time data from Johns Hopkins University, as of 7 June 30, 15, Beijing time, there were 2,092,900 confirmed cases of COVID-19 in the United States and 115,700 deaths. In countries such as Brazil and Russia, COVID-19 is spreading at an accelerating pace. At the same time, in China, where the pandemic situation is basically under control, new cases have appeared in Beijing. This means that outbreaks will persist for a long time, depending on the pandemic cycle in countries. Until the pandemic is brought under control, no country alone is likely to get better. The long-term nature of the pandemic makes the global capital market sink into the vortex of crisis, making it difficult to achieve real recovery. This market adjustment can be said to be a correction of the divergence between the equity market and the real economy. In fact, the rapid recovery in U.S. stocks means that the separation between finance and the real economy has become increasingly serious because the economy has not risen in tandem with it and is more about changes in expectations. The slow recovery in the real economy is causing investors to adjust and correct overvalued stock prices. The cautious outlook for the U.S. economy from last week's Fed meeting has raised doubts in financial markets. A flurry of cautious comments from Fed officials has further worried markets. On June 14, Dallas Fed President Robert Kaplan expressed concern about the recovery. He noted that the U.S. unemployment rate will remain high at or above 8% through the end of the year. This statement has added to market nervousness. On Monday, although the economic data released by China reflected the gradual recovery of the economy, neither industrial output, consumption, nor investment figures met market expectations. Onbound has once pointed out that COVID-19 has a long-tail effect that lasts for a long time and varies from country to country, which will have a long-term impact on economies. The inability of the real economy to recover in the short term is wearing off investors' optimism and making a correction inevitable. According to the observation of the capital market by the Onbound's researchers, the previous V-shaped rebound of U.S. stocks was actually a surplus capital effect. The unprecedented release of liquidity after the unprecedented stimulus policies of central banks in March eased the liquidity crisis and raised the market's optimism about the pandemic and the economic outlook, fueling the stock market bubble. Under the impact of COVID-19, the response measures chosen by countries around the world have not been able to get rid of the pattern of massive policy easing. Central banks' bailouts and the recovery of the world economy will also continue to exacerbate excess capital in the markets. When the negative effects of central banks' massive policy easing start to appear, the stock markets will also move towards a correction. Once markets are fully aware of the long-term and complex nature of the recovery, they are more likely to adopt cautious and risk-averse strategies, which will further push markets to the bottom. Financial markets, which have experienced a rapid V-shaped recovery, are negatively affected by the ultra-loose policies of central banks such as the Fed. In the course of the second correction, market sentiment will decline. The Fed and central banks will have a harder time rescuing the market, because the back and forth in investor sentiment will make future stimulus less effective. In addition, under the long-tail effect of the pandemic, it is difficult for the capital market sentiment to recover. Future capital markets will remain volatile, making it difficult to restore rationality. Final analysis conclusion. The continuation and rebound of COVID-19, as well as the adjustment of economic recovery expectations, will lead global stock markets into a crisis vortex of a second correction after a rapid V-shaped rebound. In the context of excess capital, such adjustments can be drastic and affect economic recovery or even create new crises. Subscribe our channel to receive the news as soon as possible. Thank you for watching.